Hi friends, Professor Joe here. I hope you all are doing great. In this video, we are going to discuss position sizing and risk management. So let us understand how much you should invest in each particular trade and why risk management is important in all investing activities, not only Forex, but all investing activities, but especially in Forex because it is a very fast market. You need to understand the risk management because if things go out of hand, it is very difficult to get it back. So let us understand the position size that you need to enter with and how to manage the risk. Now, in previous videos, I have covered what is a lot, what is a pip, what is a currency pair, what is stop loss, how to put a stop loss. Still, a lot of traders are confused. I can tell you with my own experience, I was also confused initially. I would not understand while putting a trade whether I'm investing 0.5% in this trade, whether I'm investing 1% in this trade, whether I'm investing 2% in this trade. Or sometimes I used to feel that, I should just put one particular size in every trade and one particular stop loss in every trade. Like I would put 0.05 lots, or I would put 0.50 lots in one trade and 20 pips stop loss, standard. But that is not how the market works. In some cases, your stop loss might be 20 pips. In some cases, your stop loss might be 28 pips. In some cases, your stop loss might be only 10 pips. Then how will you understand that how much lot you need to invest in one particular trade? That becomes very confusing for a lot of traders. Now, there is something called as a position size calculator. There are a lot of websites that provide you with this information also. A lot of brokers also provide you with this information. We will look at position size calculator in baby pips. Okay, so let's go to baby pips.
So here you can see babypips.com tools position size calculator, and there's a little bit written about the position size calculator. And if you scroll the screen down, you can see the details that are given. Now if your account is in US dollars, first thing you have to do is put your account balance. Say example, your account balance is $10,000, so you put $10,000 over here. Next, it is asking how much do you want to risk in every particular trade. Basically, how much you want to invest in every particular trade that you are ready to risk. Say example, you put 1%. And now while you are monitoring the charts, you see that your stop loss is at 25 pips. So you enter 25 pips over here. And your currency pair is Euro USD. So let it be as Euro USD. Okay, and once you have put all these details in, all you have to do is click on calculate. So here it is clearly showing that you have to enter with 0.40 standard lot, 25 pip stop loss to take 1% hit if the trade goes against you. Once you understand this, you go back to your MT4 or any other platform where you are trading, and you can enter this information for the particular trade. Now if you are trading in some other currency, it is very simple. You click over here and it will ask you whichever currency pair you want to enter. Say example, you want to trade in USD CAD, you enter USD CAD, and say example, you want to risk 2%, you can put 2%, and say example, if your stop loss is 30 pips, you put 30 pips. And so here when you go to any other currency, it is asking you for current USD CAD ask price. So you can go to Google and just put USD CAD ask price, and here you see the USD CAD ask price is given. It is 1.3651. So you go back to the position size calculator and you put 1.3651 0.3651 and you put calculate. So here it is telling you have to enter with 0.91 standard lot. Okay, so for in USD CAD you want to risk 2% with 30 pip stop loss. Your entry lot size will be 0.91. I hope this makes it clear to understand position size calculation.
So like you have seen in the position size calculator, how we can find out as per our risk capacity, how much lot size we need to enter for one particular stop loss. So whether it is 10 pips, 15 pips, 20 pips, how much lots you need to enter. This is very, very important so that you keep a tab on your stop losses every time you hit a stop loss. Because in Forex trading, stop loss is something that you just cannot avoid. It will always be coming. So it's important that when you lose a trade or when a trade hits your stop loss, you do not lose too much money. You do not lose too much out of your equity. This way, if your drawdown is not very, very bad or very, very steep, it becomes easy as a trader for you to bounce back. And your mental stability is also good when your drawdown is not too much. Now, when a trader starts trading in Forex, they are very, very excited about the leverage because, 1:100, 1:200, 1:500. The leverage is very, very high compared to any other markets. So a trader starts with investing 10% of their equity, 15% of their equity, 20% of their equity to make quick returns. But what they don't realize is with a 10% investment in each trade, if they lose 5 trades continuously, they are 50% down. And then I can assure you that that trader will not be able to put the 6th trade out of fear because every single stop loss affects the trader and you have to overcome that. And if your drawdown in your account is 50%, it becomes extremely difficult to come back to your break-even point. Let us look at a chart that will help you understand that when you have a drawdown, how much percentage profit you have to earn to get back to break-even. So let us have a look at this chart. So like you can see in this chart, if you have a drawdown of 10%, all you have to do is 11% profit to come back to break-even, which is really easy. If you have a good strategy in place, 101% you can recover this. But if you have a 20% drawdown, then you need to recover 25%, which is a little bit difficult, but not impossible. Actually, nothing is impossible in Forex. But there are times when it becomes extremely difficult if the drawdown is steep. So with 20%, you need to get profits of 25% to come back to break-even. With 30% drawdown, you need to get 43%. With 40% drawdown, you need to get 67% in profit to come back to break-even. And with 50% drawdown, you need to make double of what you have in your account to come back to break-even. So this becomes a very big psychological barrier that you need to double your account to come to break-even. It becomes very difficult to come back. And if the drawdown becomes more steep, 60%, it's 150% you need to recover. 70% to 33% you need to recover. 80%, 400% you need to recover. And 90%, that's 900% you need to recover. And if it's 100%, you don't need to worry about anything because your account is already blown out. So that is not a situation that none of us want to be in. So what is important is in Forex, although you have very, very high leverage, you need to keep tab on your drawdown. You need to control your drawdown. So what is the best way out? The best way out is you control on investment into each trade. How much are you going to invest into each trade? 0.5%, 1%, 1.5%, 2%. How much should be the maximum? Now, I would not give you a benchmark that how much should be a maximum or how much should be a minimum amount that you risk in each trade. As a trader, you will have to find a sweet spot as per your experience. But till you don't reach that level, my suggestion is you go with 0.25 or 0.5% in each trade to gain that knowledge, gain that experience in the market before you actually start investing, before you start taking higher risk in the Forex market. Now, let us look at a scenario where you are investing 2% in each trade and you have a risk to reward ratio of 1:2, which is a great risk to reward ratio in Forex because the opportunities are available every single day, every hour. So if you are able to achieve 1:2 risk to reward ratio and every second, third, or fourth trade you're able to get a profit, you will always be in profit in the Forex market. So in this example, we are seeing that the trader has got 5 consecutive stop losses and 5 consecutive take profits. Earlier, when we said that if you invest 10% in each trade, after 5 losses, you are 50% down. But when you are taking a risk of 2%, after your first loss, you are at 98% equity. After your second loss, you are at 96% equity. After your third loss, you are at 94% equity. After your fourth loss, you are at 92% equity. And after your fifth loss, you are still at 90% of your equity. But now your strategy starts working and you start winning your trades. So with your first profit, remember, you're going to get 4%. So with your first profit, you are at 94% equity. With your second profit, you are at 98% of your equity. And with your third profit, you are already in profit. You are above break even and you reach 102% of your equity. And with your next profit, you are at 106% of your equity. So when you plan your trade and you have a proper risk management in place and you know how much you are investing per trade, this way you can keep your drawdown in control. And whenever your strategy works, you quickly bounce back into profit, into the green zone. That's what they call. Remember, when you risk limited, you are relaxed. Always have a trading plan and stick to your trading plan. That's very, very important. Avoid revenge trading in the stock market. It's very, very dangerous. The minute you move out of your plan, you yourself know that now you're getting into revenge trading. Do not revenge trade the market. The markets are out there doing what they have to do. Your job as a trader is to pick the sweet spot to enter and get your profit. You do not have to revenge trade the markets. As a Forex trader, you also need to understand one thing, that it's okay when a trade hits your stop loss. Stop losses is a normal thing in the Forex market. You have to be okay with it. You have to be relaxed when your trade hits stop loss. Drawdowns will always happen in the Forex market. All you need to take care is the drawdown is not too steep. That's very important. Always have a clear stop loss. When I say clear stop loss, in terms of percentage, not in terms of pips. As I said, in some cases, your stop loss will be 10 pips. In some cases, your stop loss will be 15 pips. In some cases, it might be 25 pips. So if you do not understand how much percentage you are investing in each trade, use the position size calculator. I have given you an example in this video, but there are multiple such platforms that provide you with the position size calculator. And it's very easy. All it takes is a few seconds. But you can be rest assured that you are not investing too much into one particular trade. In Forex market, you need to have a lot of patience. So you need to do everything that is required to improve your patience. But a few tips are sleeping properly, exercising, meditating, spending time with your family, staying away from the screen. These are few tips that you need to follow. Also, setting a perfect risk to reward ratio. It's a part of your trading plan. A risk to reward can be 1:1, it can be 1:1.5, it can be 1:2, it can be 1:4. Remember one thing, that higher the risk to reward, that means if it's 1:4, the chances are that your profit, that is your take profit, might come once in 5 trade, once in 6 trade. Whereas if you have a smaller risk to reward, that is 1:1, 1:1.5, every second trade might be your profit. So this simple calculation you need to understand if you have a higher risk to reward ratio. If you go with 1:5 and 1:10, and if you have 2 or 3 losses in a row, it's okay. Because when you get one take profit, it's going to cover all the losses. I have already made a video on how to handle losses in the Forex market. I will attach the link of that video at the end of this video. Go through that video. It is going to be very, very helpful, because it's very important how you manage your losses when you are in Forex trading, because losses is something that you cannot avoid in trading. One thing I want to tell you is trading is the most difficult way to make easy money. The statement is very, very confusing, but it is true. People who are watching you feel that, oh, trading is so easy. All you have to do is click a button, either a buy or a sell. But the kind of efforts that is needed, the kind of research that is needed, the kind of screen time that is needed is not easy for every single person to do. So that's why it's said, it's the most difficult way to make easy money. Now, I have written a book, Traders You Can Win, but First Learn to Lose. This is exactly what I tell. You must learn to take your small stop losses. That's when you're going to become a successful trader. I have explained step-by-step process, how a trader need to understand the market in this book. And I have explained 2 strategies also in this book. There are multiple strategies where I'm going to write another book on that too. Well, I hope this video has made it clear that why the amount of investment that you do in each trade is important and why risk management is important. If you love the content that I'm creating, please like and share. And do subscribe to my YouTube channel for more such videos on finance, personality development, and interview skills. All I can say is keep learning, keep growing. Thank you. Namaskar.